Hello and welcome to the January edition of Subscribers Helpline, where we answer some of the most frequently asked questions by our subscribers of Value Research Fund Advisor. And to do that, joining me is Dhirendra Kumar, our CEO. Welcome, Dhirendra.
Thank you.
Let's begin today's conversation with our first question that has been sent in by Shankar Krishnamurthy. He is considering liquidating his stocks and mutual funds to buy a flat in Bangalore North. Will this be a good option with the next 5 years as the horizon? Or should he stay invested and buy a flat after 5 years, which will give him a better return? The flat, if purchased, will be rented out.
Which means real estate as an investment. No, it entirely depends. One is that one should compare it and look at it very objectively. What is the gain potential of this, which he will only be aware of? What is the appreciation potential of this real estate or the flat that he plans to buy? And the second is, what is going to be the rental income from this? If he will, he will get the flat, he'll rent it out tomorrow, and next month onward, he will. What that happens to, what is it in terms of percentage of the capital cost of his flat? If that is favorable, then it might be worth it. But that if there is an appreciation potential, and here is a flat which will give him a decent rental yield, maybe 5-6% or 4%. That will be very nice. Then he should consider it. Otherwise, comparing it with mutual fund, it's absolutely no nonsense. You don't even have to worry about anything. You don't even have to pay taxes. Mutual fund is such a beautiful vehicle. You're not liable to pay taxes till you realize any part of it. So it is just a matter of, choosing between two, the simple and the complex. And there are a lot of variables, and a lot of variables where realizability, the ticket size, the concentration. So it's a matter of your own choice. But I think, the choice would have been much clearer if he was thinking of buying a house for himself and right now he's living in a rented house. Then things were, I will be biased in favor of buying a house so that you start living in your home. And even if it translates into little less return, it may still be worth it. But buying a house to rent it out, just look at the convenience and complexity, and unless you are getting a terrific bargain, it may not be worth it.
Okay. Now, Raghavendra Saurabh asks, when mid-cap funds usually invest 30% in large cap, why can't we then invest in just one instead of having to invest in a separate large cap fund and thereby avoid rebalancing?
I think it's always a good idea, investing in a mid-cap. And if you are comfortable with the mid-cap ups and downs, relatively, and 30% large cap, it is fine. It's a relatively aggressive strategy, but you get. But the point is that, the mid-cap fund, ideally, this 30% large cap is an enabling mechanism. SEBI laws or regulations about categories say that, it can well be up to 30% into large cap. But ideally, if it is a small sized fund, and I would expect a mid-cap fund to be fully invested in mid-caps only, and nothing which prohibits them from that. And the average allocation of mid-caps in large caps in the mid-cap mutual funds was about 12%. So they are enabled to invest up to 30% into large cap or non-mid-caps, so to say. So yes, I agree with him. And with that in mind, I would say that, if you're looking at exposure across large cap, mid cap, small cap, and necessarily, and flexi caps are facing a problem in terms of most of them have become so big that they are getting tilted to be, they're almost looking like large cap funds because they have all become very big, and 80-90% money is invested in large cap. So there, why my reason for going for a multi-cap was to necessarily get exposure to all the components of the market. I'm able to better achieve it with a multi-cap fund, which is forced to invest at least 25% into large cap, mid cap, and small cap, and rest of it is his discretion. So I would say that consider if you want exposure to all segments of the market, multi-cap might be a better way. You are right that mid-cap funds can have 30%, but most mid-caps are expected to be substantially mid-cap.
Now, moving on, Naveen Sharma wants to know if it is advisable to switch from a regular to a direct fund even when the market is down, or should one wait for an upswing in the market?
First and foremost, moving from regular to direct is a good idea. Now, bad state of the market or good state of the market, I don't think that is the primary concern or should be your primary concern. Your primary concern should be, is your investment less than 1 year? If it is less than 1 year, then you have to be watchful of the exit load as well as the 20% capital gains tax, because that is a bigger problem. The moment it becomes more than 1 year, most equity funds levy, they become load free. There is no exit load on, generally speaking, on holding of more than 1 year. Second is that, your tax rate also comes down to 12.5%. So state of the market is not a concern. Once you have decided that you can take charge of things yourself, move from regular to direct. And for value research fund advisor users, it's very simple. Go to your portfolio and on Value Research Online, and the 3 dots at the end of the row of each fund, you can actually decide to redeem or switch. And switch is a single click thing. Of course, switching from the regular plan to direct plan amounts to redeeming a fund, redeeming that investment and making a new investment. But once you have decided, you should do it as soon as possible, but just be wary of the exit load and the tax thing. And Value Research Fund Advisor interface enables it seamlessly. With 2 clicks, you can do it.
Now the next subscriber says, in order to generate income from my savings after retirement, I was using Portfolio Planner. 6 funds were suggested, which include 1 liquid fund, 3 short duration fund, 1 large and mid-cap fund, and 1 Flexi-cap fund. All these funds are from different AMCs except for one. As there is only 1 liquid fund recommended for SWP corresponding to 1 short duration fund, I need some clarification. Whether I need to have a separate liquid fund against each short duration fund, Flexi-cap fund, large cap and mid-cap fund from respective AMCs, whether I have to plan SWP from all categories of funds, distributing the SWP amount. I am already investing in some funds which are not in the suggested list from the portfolio planner, and if I switch to recommended funds, then I have to pay capital gain. Also, as per the planner's suggestion, balance your portfolio at the start of every year to make sure the allocation of the equity investment stays in 30-40% range. This will also increase my capital gain.
He has many questions, and let me answer them methodically one by one. One is that 1 liquid fund is good enough because you have to invest your money for sake of simplicity. Do your SIP from a single liquid fund so that your income needs and you don't have to worry about it, and that is why we suggest that keep it simple. Park that money, your annual requirement, and set up your SWP, end of the story. Second is that I agree with him that if he has some good funds, he has already invested, redeeming them and following what portfolio planner is suggesting may not be a good idea. Don't do that. If the funds that you hold, if they are buy, or they are in the best buy list, or they are in the buy list, or they are in the hold list, hold on. Consider them as your equity investment. You don't need to necessarily redeem it and buy it. Because portfolio planner is not taking into account your existing holdings. Portfolio planner is thinking of a stranger. He comes to the portfolio planner, he's asking for something, so it is giving you a diversified portfolio depending on your scale, depending on your experience, and giving you a portfolio which will be the best portfolio for your needs or for your goal, for your time frame that you have specified. But if you already hold some equity fund which is either a best buy or the buy or a hold on, consider them as well. Just make sure that the funds that you have, they are also diverse, they are spread over multiple fund companies and things like that. And because portfolio planner is taking that into account. Assuming that I have to suggest, if the portfolio planner has to suggest 1 crore rupee investment in equity fund, then it will be suggesting 4 funds of different fund companies, maybe 4 flexi-cap fund, 4 multi-cap fund. So you need diversification at different level, and portfolio planner is able to take that into account. So if you can do it yourself, by all means do it. Second is that, capital gains is a very important thing. You should save on taxes as much as possible, but don't worry about the fixed income bit. You cannot escape, capital gains on fixed income, and you can't even, and you don't have any advantage with a mutual fund anymore, and you don't have advantage with a deposit or a money lying in your savings bank account. The only convenience that mutual fund provides is that, it is a tax deferred thing. Till you realize it, you are not liable to pay taxes. So don't worry about it, and the focus should remain on maintaining a balance, making sure that you are closer to the desirable asset allocation. Getting too equity tilted or becoming too conservative with fixed income might be disadvantageous to you, or you might be assuming great risk which may not be desirable. Decide on the asset allocation and be anchored around it by 5-10%, not more than that. More than that, then time to rebalance. In our overall plan, whenever we are making suggestion, we suggest that don't rebalance every now and then. Don't look at the asset allocation every month and do a rebalancing. Assuming you have chosen to have an allocation of 30-40% to equity, remaining in fixed income, then you should not be rebalancing every month, because the markets will go, out of whack every now and then. Make sure that, you have a rebalancing framework of 1 year, not earlier. So that is one. The other is that the rebalancing does not require too much of churn. You just have to move a part of your equity fund, equity assets into fixed income, or fixed income into equity to restore your balance. You don't have to really churn your whole portfolio. And also the kind of withdrawal you have to do periodically, it should be done in a manner that it also translates into rebalancing for you. So ensuring that your allocation does not go out of whack is very important, because and you should do it not very often, you should do it annually. It's very important to keep the allocation on track, otherwise you'll just be assuming too much risk.
Sanjeev Sangal says redeeming poorly performing funds or pruning an excessive number of funds means paying a lot of capital gains tax. Tax harvesting is too small to make any worthwhile impact. So how do I plan redemption?
One is that death and taxes are unavoidable. You have to pay tax. But the point is that, earlier, many years back, equity was, all the gains from equity was completely tax-free. But you can't escape taxes anyway. But and tax harvesting, or doing some kind of mechanism that you are sitting on losses and elsewhere, and you are able to do a transaction to create some tax loss to offset your gains here. That is one possibility, but don't work too much on that. Poorly performing fund, just think of the opportunity cost. If you will not invest in this fund, if you have to choose a fund today, you should not stick around. You should not hold it, and you should, so that your money becomes on track, starts working to your satisfaction from here on to best of your ability. Sticking around for losses, poorly performing fund, and just because it will save you tax, there are reasons why people should, there are reasons why people should just redeem even if you are sitting on gains. For example, moving your money from regular plan to direct plan. The benefit starts immediately after you switch, though there could be a tax implication there too. A poorly performing fund is the second most important reason why you should do it as soon as possible. Third is that, if you're nearing your goal, if you're approaching your goal, if you invested for a certain goal, and if you're closer to that, might as well redeem it a little earlier than expected or than planned, so that the money gets into gets back to you. Third is that, the other reasons, there's a change in objective, or you choose a category of fund. The fund remains good in its own way, but it no longer fits your requirement. You invested in a Flexi-cap fund or multi-cap fund, but now you have retired and you want to actually have a very passive way of looking at. You want a low maintenance portfolio. You want just 3-4 aggressive hybrid funds so that you don't have to worry about the rebalancing. You don't have to worry about taking money out, or concessional tax treatment of the fixed income allocation of 25%. It just might be very tax efficient. So For those reasons, your needs change, your choices can change, but poor performing fund, make that change immediately.
Okay. Now, Prashant Rudra has been doing an SIP since 2009. He says, I have a non-negotiable commitment of 7 lakh rupees per year for 3 years for my child's education at present. Shall I withdraw a lump sum of rupees 21 lakh from my mutual fund corpus into a fixed income fund and pay yearly fees from that? Set up an SWP of 7 lakhs scattered over the year into fixed income, pay the fees and do this for the next 3 years? Withdraw 7 lakh rupees per year at one go and pay the fees.
I would suggest a very simple plan. Take out 7 lakh rupees every year, but take it out 6 months before you need the money and pay at the beginning of the year that fee of 7 lakh rupees every year.
So the next question has been sent in by Rohit. He says, my father aged 72 will shortly withdraw 12 lakh rupees from his PF, which has now matured and will not give any more interest. How best can he invest it?
One is that person at 72 and who has not been used to the market linked returns or investments. He may be very uncomfortable with what happens. So I would suggest that put 10 lakh rupees in a senior citizen savings scheme. It is the highest yielding guaranteed income scheme for senior citizens, and there can't be anything safer than that. And 2 lakh rupee, put it in a multi-cap fund or a aggressive hybrid fund. That way, that 2 lakh rupee will take care of some upside, and that will give him the guaranteed income, because if he needs supplementary income which he was getting from his PF, that will be substituted by investment in senior citizen savings scheme.
Now moving on, the next question is from Ranjan K. Nair. He's 59 years old and has a reasonable level of risk appetite. He plans to invest 1.5 crore rupees accrued from property sale into equity. He says he will need this money only after around 12 years or so. He has 3 questions. 1. Which type of fund should he invest in? In how many months should he spread the investment? And he wants to know your opinion on choosing some index funds that track the Nifty Midcap 150 index.
1.5 crore rupee, very important money to be invested, and for next 12 years. I would say that it should be invested in equity. Now, which kind of equity? It entirely is a matter of his experience with equity so far. If he has been an equity investor in the past, then I would say that he should consider, 1 or 2 multi-cap fund and spread that money over the next 18 months. Because even after that, his last year, SIP installment, even after that, it will have 10 years to work. Second is that, there are multiple ways of achieving this. It could be, 1 or 2 multi-cap fund, or it could be 1 large cap index fund backed by, small cap and mid cap fund of different fund companies.
Now the last question has been sent in by Abhishek. He says, Dhirendra Kumar, I love your videos. I found them very informative as I started my investment in mutual funds. I heard you often say that aggressive hybrid funds are the go-to category for new investors. So I have invested in 2 such funds for a 10 to 15 year time horizon. But I have also invested in other funds for long-term wealth creation. 1 Flexi-cap, 1 large cap index fund, 1 mid-cap index fund, 1 international fund, and no small cap yet. I heard you say do asset allocation and rebalance your portfolio as well. Now I need clarification on how to rebalance after a 5 or 6 year period and how much to include debt in the portfolio, as I have hybrid and Flexi-cap in the mix. Note, I have done this to see the best of both worlds as I learn while I invest.
No, you are doing a good job. And for most investors, for most passive investors, for investors who want a low maintenance portfolio, aggressive hybrid funds actually do 90% of your work. It is invested in equity, it is invested in fixed income, it is getting you the benefit of equity, it is providing you the stability with its fixed income allocation. You don't have to worry about rebalancing. The fund manager does it. You are not liable to pay taxes till you realize it. So it is a steadier take on growth. It's a beautiful design and structure. And more so now, 25% money invested in the aggressive hybrid fund, the 25% of the money which is invested in fixed income, is not taxed as fixed income. it is taxed as equity, which is 12.5%. Had it been invested in fixed income fund, then it will be taxed as, the standard rate much higher. So it is treated as your income and depends on, the taxation will depend on the tax bracket you fall into. So I would say that having all this, I saw your list, having a Flexi-cap as a supplementary to aggressive hybrid fund is fine. I don't understand the reason to have a large cap fund anymore. If it is an actively managed fund, maybe substitute it with a index fund, because today you have the Sensex or the Nifty fund available at 10 basis points, save on the expenses. And one international, one mid cap, I think this is also a great choice. It's a great supplementary investment, and all of them combined together will make a great portfolio. Now the point is, how should you rebalance? How will you figure out the asset allocation? Just look at your portfolio, look at the portfolio dashboard and see how much of your money as a result of, because yours is still simple. There is a possibility of you having NPS, you having some stock as well, some investment in equities directly. As a result of all this, what is your asset allocation? You will get at the dashboard of your portfolio tracker. And on my portfolio at Value Research Online, the dashboard, if you find that the asset allocation is something, maybe, that is the time when you should reduce your equity to, get your allocation back to rebalance it. So rebalancing it becomes easy because you are able to get a very precise status of your asset allocation adjusted for the month-end disclosure of the portfolio of every fund. And how to rebalance? When equity does very well, then it goes up, and if fixed income does well, and this will take into account the money that is invested in aggressive hybrid fund. It will take the fixed income component of that, and as a result of which you will get your asset allocation. So make those changes, add fixed income. If equity has gone up, redeem some equity. And you will not get an opportunity to do this from aggressive hybrid fund. You will have to do it only with the equity fund when they appreciate too much.
Okay. Well, that's all for today's episode. Thank you for watching and keep sending us your questions.